What's up, guys? Welcome to the Cash Craft, your daily dose of finance and technology news and updates. Your retirement account is holding stocks that might not exist in 5 years, not because of a crash, not because of fraud, because artificial intelligence is rewriting the rules of which companies survive and which disappear. And most retirement portfolios are built for a world that's already gone. Here's what's happening right now. AI isn't just another technology cycle like cloud computing or the internet. It's a force that's simultaneously creating trillion-dollar opportunities and destroying century-old business models. The same technology that could mint the next generation of mega corporations is quietly marking others for extinction. And if you're over 50 with a traditional stock-heavy portfolio, you're sitting right in the blast radius. William Baldwin at Forbes just published an analysis that should make every near retiree uncomfortable. The core problem: most retirement accounts are loaded with equity exposure at exactly the moment when AI is making that equity exposure more volatile and unpredictable than it's been in decades. We're not talking about normal market fluctuations. We're talking about fundamental uncertainty about which businesses have a future. Think about what AI is actually doing to corporate America right now. It's not a gradual shift. Companies that seemed untouchable 18 months ago are suddenly facing existential questions. Can their business model survive when AI can do their core function better and cheaper? Do they have the infrastructure to compete in an AI-first economy? Are they the disruptor or the disrupted? The traditional retirement advice was simple. Load up on stocks in your working years. Shift to bonds as you approach retirement. That worked in a world where corporate hierarchies were relatively stable, where the S&P 500 constituents didn't change dramatically year to year, where you could reasonably predict which companies would still be dominant a decade out. AI is torching that predictability. Here's the specific mechanism that should worry you. Retirement portfolios are typically heavy in large-cap stocks because they're supposed to be safer, more stable. But many of those large caps are now in a race they might not win. Meanwhile, the companies that will dominate the AI era might not even be public yet, or they're small positions in index funds, or they're concentrated in a handful of tech giants that are already overvalued by traditional metrics. You're either overexposed to legacy risk, or you're chasing an AI bubble that could pop. Baldwin's analysis points to something most financial advisors aren't saying out loud yet. The old risk models are broken. When you're 55 and planning to retire at 65, you can't afford a portfolio that gets cut in half because the companies you own couldn't adapt fast enough. But you also can't afford to sit in cash while inflation eats your purchasing power and the AI winners compound at rates that make the internet boom look modest. What most people don't realize is that this isn't a problem you can solve by just picking better stocks. The issue is structural. AI is compressing the timeline of creative destruction. Companies that would have had 10 years to adapt now have 18 months. The margin for error has collapsed, and retirement accounts, by their nature, are long-term holds that don't react quickly. Here's the reframe that matters. AI isn't just a sector risk you can diversify away. It's a systematic risk that touches every industry. Your healthcare stocks? AI is transforming diagnostics and drug discovery. Your financial stocks? AI is automating everything from underwriting to trading. Your consumer goods stocks? AI is reshaping supply chains and marketing. There's no safe harbor in traditional diversification because AI is the water, not the boat. The question you should be asking yourself isn't whether AI will disrupt your portfolio. It's whether your portfolio is positioned for a world where the winners and losers get sorted faster than any previous technological transition. If you're holding a traditional 60-40 portfolio and you're within 10 years of retirement, you're making a bet that the next decade will look like the last 3. That's a bet you should examine very carefully. Personally, I'm treating the next 5 years as a period of maximum uncertainty. I'm not abandoning equities, but I'm thinking hard about which companies have real AI moats versus which ones are just riding the hype. And I'm keeping more dry powder than traditional allocation models would suggest, because the repricing events are going to create opportunities that only the liquid can capture. That's all for today, folks. If you found this helpful, make sure to like and subscribe to the Cashcraft for more finance and tech news. Drop a comment below with your thoughts, and I will see you in the next one.